We were going to go over some mistakes to avoid when using systematic trading system or an algorithmic trading system. And the first is overconfidence. The biggest mistake you can make is to be overconfident in your trading. People consistently overestimate their own abilities, both in absolute terms and relative to others. In the jargon of behavioral finance, relative overconfidence goes by the catchy title, Illusory Superiority. Feeling a sense of illusory superiority is extremely dangerous. And studies frequently show that more than 90% of drivers believe themselves to be above average. It's likely that 90% of traders and those designing systematic trading systems also believe they're in the top tier. And clearly most of these people are kidding themselves. Overconfidence manifests itself in nearly all the other mistakes listed above. If you think you're better than the rest of the market, you're more likely to trade too often and take too much risk or to design a system which makes those errors. According to market lore, the very best discretionary traders are those who are humble enough to admit they are wrong and cut their position when it moves against them. And the same humble attitude is necessary for those creating a trading system. 2 is living in an ivory tower. Many people who design trading systems do not come from a trading background, but from a scientific discipline such as physics, mathematics, or engineering. This can be a very good thing for a couple of reasons. Firstly, they are more likely to be able to design robust, automated trading systems. Also, if you have been trained in the dark statistical arts, then you should do a better job of fitting your trading system than a novice who is blindly using a piece of backtesting software they do not understand. However, those are scientific black belts, but neophytes at trading are prone to making serious errors. Some of the biggest blowups in trading history have been caused by extremely clever and well-qualified people making huge mistakes. The meltdown of long-term capital management in 1998 happened despite the fund having 2 Nobel Prize winners on their staff. Derivatives backed by subprime mortgages were radically overpriced before they crashed in value in 2008, thanks to traders using a clever model created by a very smart guy with a PhD. And other examples include the quake of summer 2007 and the losses suffered in the Swiss francs devaluation of January 2015. In all of these cases, the rocket scientists had created a model which was a good approximation to reality most of the time, but ignored the very different dynamics of a market crisis which were missing from their data history. Experienced traders, bloodied by numerous market crashes of the past, are more likely to design trading systems that can cope with these extreme situations. Other common screw-ups by those short on practical experience include underestimating the cost of executing an order and ignoring a critical element of market structures such as stock splits or short selling constraints. A successful systematic trader will have both a good understanding of theory and a big dollop of market savvy. The next one is overcomplicating. Rocket scientists have another fatal flaw, the tendency to overcomplicate. If you're very smart, then it's tempting to think that to beat other people in the market, you have to exploit your intelligence. After all, that is the edge that you supposedly have. After creating a simple run-of-the-mill trading system is far too trivial a task for someone with a PhD in signal processing or nuclear physics. Using your scientific knowledge to produce a wonderful, elaborate strategy is much more fun. Overcomplication can also happen when you start a relatively simple trading rule. After testing this, you discover that it does not perform as well as you had hoped. So you adapt it, fine-tune it to improve its performance by adding some bells and whistles. A few more iterations and you have something that is far too complicated. This is also a form of overfitting. The bad news is that complex systems are generally outperformed by simpler alternatives. Complexity is also bad because it makes the system opaque. A good trading system is predictable. If the market moves in a particular fashion, you should be able to predict roughly what your strategy should do. And if you understand your system, you're more likely to trust it and run it unimpeded. The next one is overfitting. Another manifestation of overcomplicating your system is the use of complex backtesting and fitting techniques. Neural networks, support vector machines, artificial intelligence, and all things big data are very popular right now. These methods make it very easy to overfit. This is where you train your system to do extremely well in your past data, but end up with something that won't be robust to market conditions, but end up with something that will not be robust to market conditions, changing slightly. Inevitably, overfitted trading systems are unprofitable when actually implemented. Overfitting is not a disease limited to those using fancy data mining tools. Even very simple techniques are vulnerable. Although with a simple method, it's usually easier to know if you are overfitting. For example, consider the simplest form of fitting: test and throw away. Here you consider each possible variation of your trading strategy in turn, discarding those that are not sufficiently profitable. The more variations you test, the more likely that you will discover an apparently wonderful trading rule just by chance. And to produce a trading system that will do well in reality and not just in the hypothetical past, you should either use simple trading rules which are not fitted, or a robust fitting methodology which steps through history without looking into the future and ensures that parameters only allowed to vary if the underlying data justifies it. The next is under-diversify. Discretionary traders often concentrate on a few markets, perhaps a few stocks, a couple of currency markets, or a handful of commodity futures. When they come to designing trading systems, people usually stick to what they know and understand. However, the benefit of a systematic trading strategy, particularly one which is automated, is the ability to trade large number of markets simultaneously. Because each instrument does not need time-consuming manual analysis, the size of your portfolio is limited only by the amount of trading capital you have to deploy. It's also fun and interesting to indulge yourself in coming up with more esoteric ways to predict the price of your favorite markets. Much less fun is devoting yourself to the tiresome task of uploading past data so that you can use your existing trading rules on new markets. However, relatively simple systems which are diversified over large numbers of instruments are likely to perform significantly better than a complex system running on only a few assets. This is because the returns of the diversified simple systems are likely to be relatively uncorrelated, resulting in higher benefits from portfolio diversification. The next is overtrading. Another manifestation of overconfidence is trading too much. An unrealistic backtest might show that you could earn serious money if you buy and sell dozens of times a day. When combined with unrealistically low expectations of trading costs, the result is a system that will make someone a lot of money. Unfortunately, it will be your broker and the market makers that will benefit from this, not you. And you should have realistic expectations of what your likely returns will be and ensure that these will cover a conservative estimate of trading costs several times over. The next is overbetting. Overbetting is taking too much risk. It's a mistake made by many discretionary traders. Designers of trading systems are just as likely to be convinced by the siren song of high returns that can be earned when leverage is increased. Suppose your backtest shows you could have made 50% a year with a maximum drawdown of 10%. Then it seems obvious that you should leverage the system up by, say, a factor of 5, so you can earn 250% a year with a bearable 50% drawdown. Those kinds of backtest numbers are very unrealistic. Sooner or later, someone running with this much leverage will see an unexpectedly large adverse price movement, and the rapid depletion of their account will follow. It's much easier to be realistic and even pessimistic about the likely returns and losses of your trading strategy, and to run your system at a relatively low risk target. The next is lacking commitment. Having a well-designed trading system is a complete waste of time if you're not committed to it. Your trading system signals a buy, but you ignore it as you think the market will pull back. When it doesn't, you enter the buy order but end up paying a higher price. Then there is a sell-off and the system commands you to close. But you ignore it only to see the price collapse, putting you in a deep hole. You should either be a discretionary trader or a systematic trader. Either you have a system or you don't. A trading strategy will only work if you commit to it entirely. You cannot pick and choose the trades that you like and ignore the rest. By fully automating your system so it trades automatically is one way to make commitment easier, but it will leave you open to meddling, which is the next one. And what is meddling? This is lacking commitment and completely ignoring your system, which is very dangerous. But there's a more subtle and insidious form. Lacking commitment and completely ignoring your system is very dangerous. But there's a more subtle and insidious form of interference that we like to call meddling. This is where you make numerous changes to your system parameters to change its behavior. Suppose there's a non-firm payroll number coming out later today. You're nervous about the amount of risk in your portfolio. So you adjust the variable cost that controls your overall leverage. Lo and behold, the system issues a series of closing trades. Strictly speaking, you are still blindly following your system, but then you have already altered the strategy so its positions are more in line with what you think they should be. Melding can be justified as risk management, as in this example, or as an improvement or adaptation to the system. A well-designed system will do its own risk management. Also, if sufficiently well-designed, it should not need improving. At best, an improvement will be of marginal value and not statistically significant. Unless you're trading very quickly, it's unlikely that even several years of live trading will provide enough evidence that your system needs adapting to a new market condition. And changing your system should be a rare event. At best, you will incur extra trading costs from frequent changes, and at worst, you'll significantly reduce the returns that your system could have made if left alone. In summary, avoiding these 9 mistakes is not guaranteed to make you money, but it will help you to avoid serious errors that will probably lead to significant losses.